Hey, good afternoon, everybody. On this Thursday, Market Mavericks are back, and we got the three amigos with the coolest kid in town right here. How are you guys doing today?
We're doing good. How are you doing?
Good.
We're good.
Very cool.
Unfair to that guy.
You are saying hi to both of them, but we got to go to work now.
What did he say? He said Bitcoin's going up?
He said Bitcoin's going up when you guys.
Nice. Awesome. All right, guys. So we have a lot of data, right? I mean, holy cow. We had the Fed yesterday. We had CPI yesterday. We had PPI this morning. What do you guys want to do? I mean, you guys, Mike, you want to break it down for us? What does this all mean?
Sure.
I mean, are we going into deflation? I mean, what's going on?
Yeah, so I can share a screen and show a few charts. I think the answer is yes. It's just a matter of time. So I'm just showing you a bond chart from U.S. Treasury 10 years, 424 at the bottom. You see China, 229. Germany, 3 handle. Canada, 3 handle. Obviously, Japan's below 1 handle. It's just a matter of time we catch up to the rest of the world that's plunging into a deflationary recession, most notably China. I look at this as a chart that we've been looking at forever, and that's Fed's easing expectations. Looks like the full probability of an ease is until November, right after the election.
Not to jump in, Mike, but let me ask you a question, right?
Please.
So you're talking deflation, but I know most of us out there are still like, what the heck? My car insurance keeps going up. My bill going out to eat keeps going up. So like, where is this? Are we all of a sudden going to see price cuts in these bills?
You're going to see all right, let's take the risk of a prediction. I think we're going to have a deflationary recession worthy of the biggest inflationary money pump in history. And I'm going to describe that from this chart here. Going back to, this is the S&P 500 divided by GDP since 1947. I just take GDP in trillions times 100. Right now it's 28 trillion. Add 2 zeros. It's equivalent of S&P right around 2,800. It's the highest on the way up since 1930. Just to give an example, it's basically almost in market capitalization. S&P 500 is easy because it's easy to go back. Market capitalization, I can't go back as far, but basically at $55 trillion total market capitalization in the U.S. stock market, it's 2 times GDP. It always reverts. It always has. And the key thing is you have to look at what got us here. We had the longest period in history rates on a global scale of 0 or below 0 interest rates. It's logical. Risk assets get expensive. That's just gone away. We just haven't got to the point yet where we're taking those risk assets back. We will. We have in China. You look at that HSI, it's collapsed and bounced. But this is just a matter of time that it reverts to the mean. Now, maybe it's different this time. But that's my point about deflationary recessions. It always comes on. They oftentimes come in the back and getting too expensive. And I'm just looking for the signals. Now, I look at from a commodities standpoint, it's already happened in some commodities. Look at natural gas. It plunged to the same level as first traded in 1990. Crude oil, it's trading right now the price of the first trade in 2007. Now, some things like copper and gold are going up, but the inflation you're seeing right now is almost all on the back of this money pump, a monetary phenomenon, and the confluence of 100-year events that are all going to come trickle down. And the bottom line for me is down to one thing, is the stock market. At some point, when we have some reversion in the stock market, then you're going to see that reversion start. I'll end with this. There's one thing that really struck me when CPI hit this week is unemployment's moving upward. This is what you see here. Unemployment's moving upward. And if you look, it's at 4%. We've never had it bottom at 3.4% without going to 6% ever. I only go back to 1947. Now, we've heard to say this before. What's significant is CPI, ex-food and energy, has plunged below the unemployment rate. This is a year-over-year level. The last time that happened was 1982, the severe recession. Now, I just remember that from my father. He was running a steel company. He said, Mike, that was almost as bad as the Depression. But the thing I want to end with and compare to is the one thing this is really comparable to is 1971. Right around here, unemployment was going up. CPI declined, they crossed over, and that's right before Nixon took us off the gold standard. So I look at, and the difference is, I just have to show this chart. Back then, the gold versus S&P 5 ratio was exactly about the same as it now. It means gold was very expensive, and the S&P 5 was very cheap. And it just right from about 0.4 to 0.2, like gold went to like 2 times the S&P 500. Now it's at a steep discount. So to me, that's just what's going to happen. This is a question of when.
So Scott, like I'm looking at the 10-year chart here, and we've obviously seen a breakdown after the CPI and the PPI data. But like, I mean, are you seeing deflation as being potential? Like, it's for me, it's so hard to get my head around it because I feel like as soon as the economy weakens, the Fed's going to come out with this gangbusters and jack up their balance sheet. The government's going to keep spending. I mean, heck, we know that the government's refinancing, and the amount of interest we're paying is already $1 trillion basically, and that's just going up. So for me, and I don't know, maybe people watching too, it's hard for me to imagine that we get to deflation. What do you think, buddy?
I am on team. I have no idea at this point.
Yeah.
Honestly, I think it could go either way. I listen to Mike say it every week. It makes absolute perfect sense. But then again, we know that they will eventually just step in, like you said, and print. I find every metric we're seeing, at least the ones that are released to the public that we're basing our decisions and opinions on, to be so utterly confusing and mixed at this point that I don't even know how to read it. And I've never really felt that way before. Like last Friday, we had the job numbers come out. Obviously, the headline was that there were a ton of jobs, 275 versus 185 expected. Markets went one way. Then you dug into it and realized that, full-time jobs were effectively gone, over 600,000. It was mostly part-time jobs. The way they made the numbers were likely wrong, and we know they'll be revised anyways. Right. Then we get a good CPI number versus expectation, but then a more hawkish, I would say a more consistent Jerome Powell, to be honest. People say hawkish. I just say the dude's never said anything different than he was saying before, and markets want to view him as hawkish. But then we get good PPI numbers, good today. But I don't really believe the numbers. So it's just so mixed and confusing. I don't want to give a really hardcore opinion either way because I just don't know. As I've said many times here, I'm very impressed with the levers they have to pull that I didn't even know about to make sure that the stock market or that the economy stays propped up.
Yeah, and just to mention, this morning we got the jobless claims, the initial claims for unemployment that spiked up to 242,000, which is the highest number since last, I think, August of 2023. So it kind of goes in the face of what we just saw, like you were saying, with the jobs number last Friday that was so supposedly strong. Yet here we see these numbers for people filing for unemployment starting to spike. And I think, again, if you look historically, is once we get towards that 300,000 level, that's the real warning sign that people are losing a lot of jobs. And we likely are headed towards recession. But again, just like, to me, it's like, yes, if the Fed did not intervene, absolutely deflation makes sense. But it's just like they're so programmed to jack that balance sheet up every crisis, every minimal crisis. And then they just keep it in there.
But it's less effective. It is less effective each time. It's kind of like a lower high, each time.
A negative divergence.
I can tell you this, that the government, the Fed, are much more fearful of deflation than they are of inflation. A Great Depression is the last thing any of them want to be presiding over. So to your point, Gareth, I do think they'll do their best.
Because I mean, like, at least politically, isn't it? Like, if you can come out and say, hey guys, the prices of McDonald's went down 10% this year, great. But like, instead people are like, what the heck?
Listen, you're talking about deflation in a free market, the Jeff Booth price of tomorrow theory, where we live in this deflationary utopia and people don't work as much because goods are so cheap that we all have free times to paint and, we live in a modern renaissance. That's what would happen without the Fed and without the government. The reality is deflation and everybody losing their jobs and, doctors sweeping the streets for a pittance is not what the government wants. That doesn't get people elected. I believe that if we get close to that, whether successful or not, they will print their asses off.
You know why deflation is so scary to a lot of politicians is because if you actually have prices going down, think about what earnings are doing for companies. Like, I mean, we're not just seeing zero earnings growth. We're seeing real negative earnings growth. And then we know the stock market crashes, basically. And then you're right. Politically, that would not be popular. Absolutely. All right, Mike, weigh in on this. What are you saying?
Yeah, I got to weigh in. So I think it's the lessons of history, partly from Jeff Booth, that we've learned. Not Americans, but humans are all about error correction. I show it you here. The thing that's different this time is interest rates went up on the elevator. It's the first time I've ever seen it. And I was a bond trader on trading bonds in 1994 and 5. They're in that massive rally in bond yields and hikes. And the difference is they're going to go down in the escalator because we've created the lesson, we've learned the lesson, or we probably will learn that lesson of way too much liquidity and inflation. We've learned also inflation really crushes votes because we know that inflation hurts the smallest guy, the majority of people who are not the wealthy elite, which we basically are. If we own homes, if we have salaries, and we make decent money and own stocks, you're basically the Western elite. Most people in this country, I understand it's 55%, are wage earners. And inflation hurts them the most. So that's what I show you here. It's a matter of time we get it. It's just a question when. And my bias is this is very 1929-ish. It's the last time we were this expensive on a stock market, macro market capitalization to GDP on the way up. And what it did is it lifted all the boats, and then it tilted down to the Great Depression in 1930s. Now, Smoot-Hawley tariff factor hurt that, but yeah.
I'd love to ask you a question for historical context. What levers did the government have for money printing in 1929 that they may not have now? Is there anything that's different? It seems like they're much more able now to manipulate or, prop up markets than they could then.
And actually, the number one lever is we have lessons of history. We learned what we did wrong then, which we're kind of doing now. With the Smoot-Hawley Tariff Act was really what accelerated. But the New York Fed started cutting rates in 1924. It's the lowest in the world. That helped accelerate the rally. And then they actually started hiking rates when things got on hand in 1928. And then they started cutting again as things went down in I think it was by 1930. So rates were not a big deal. So we have so much more levers and stuff. It won't be as bad. I'm pointing out facts of cycles in history. That's how expensive equities are. And that's why I think last time everything started with housing. Remember, housing peaked in 2006 and the stock market didn't go down in 2008 and everything bottomed around 2009 and 11. It's this time now, it's all about stocks holding up everything, holding up inflation. That's the chart I showed last week is when you get this much GDP or stock market capitalization in GDP, it's all that matters. And the comparison was to 2000. Remember, CPI was running exactly the same as it is now, 3.4%. It stayed sticky until the stock market went down. Now, back then, as I point out, the stock market wasn't near as expensive as now, but it kept CPI sticky, and CPI did not go down until the stock market went down. I think the Fed gets this. We're seeing this delay. The whole world is starting cutting rates because the world's heading towards a deflationary recession. China's the leader. They're trying to export a lot of cheap stuff, and the U.S. is the bastion of support. And the bottom line is the U.S. stock market's holding up everything. And when that gives a little, dominoes tumble. For now, it's wonderful.
So, Mike, game this out for me then. All right. So let's say we start to see deflation, which maybe we're starting to see, and then the printing presses come out. Does that mean that the markets then go to new all-time highs, or is there going to be a breaking point in the system where it just can't handle the liquidity and there's some sort of crisis?
One bridge at a time. We're not going to see liquidity until markets go down. And if we do, it's just silly, stupid leadership. And that's what's different this time. And one thing I want to show you is how low volatility is. This is what just a 52-week moving
average.
China
is letting banks fail now, by the way, right? I mean, think about that.
But that's doing some of that. But to me, the bottom line is one thing we learned about the tide's got to go out first, and then you get that. But people are just making all these assumptions what the Fed's going to do and all liquidity is going to come in, and they're buying into it. But they're buying into the most expensive market ever. And my point is, that stuff doesn't happen until you get the reversion lower, and then we'll see how the markets react. But we're going to get some liquidity. My point is, it's going to be lagging like the opposite of what we used to, because inflation will stay sticky until things go down. This is a point of thing I show you is when you get volatility this low in S&P 500, which is my key signal 2007. I was really early. I was wrong, but 2008, I crushed it just because I expected volatility to revert higher. That's all we're seeing. But the difference is, I'm just showing you here, this is a Chinese 10-year note divided by the U.S. 10-year note. It yielded a lot more than the U.S., and now it's plunging. That second largest economy in the world is collapsing in terms of deflation.
Crazy.
Gareth, can I ask Mike another question?
Of course.
If you don't mind. Or actually both of you, but I want to talk about my screen is not up for some reason, but the petrodollar. Can you unpack this for me a little bit, Mike? Because I was traveling and haven't really had a time to look at it. But Saudi Arabia ends petrodollar agreement, what it means for the USD, Bitcoin, and gold. I mean, this goes back to the 1970s, obviously, that effectively you could only use dollars, right, to trade, to do oil deals in Saudi Arabia. That's ended. How meaningful is this?
It's called deflation. What's happened is it's how wonderful things are happening in this country. Jeff Booth pointed out rapidly advancing technology. That made a lot of sense. I remember the 70s very well when the U.S. was the largest demand pull importer of crude oil in the world and Saudi Arabia was the largest exporter. Now we are a competitor to Saudi Arabia. We, with Canada, we have a surplus of 6 million barrels a day in crude oil and liquid fuels. To put that in context, Saudi Arabia's and OPEC's rising surplus, rising spare capacity is around 7 million barrels a day by various estimates. It's just a losing method. It's a lose-lose for commodity prices, most notably crude oil. And then you see what's the biggest problem with China right now. All the other countries in the world are pushing back, and they're really cheap renewables, like BYD. It's bringing out a car that I own that cost me 30 grand. And they can get it for 13 now. It's a plug-in hybrid and it gets double the range. It's just where things are going. But I wanted to show you one thing on crude oil. This is crude oil. This is Brent. It's been holding this trend line for quite a while. It should hold it in the near term. And I fully expect WTI to get to $40 a barrel, get to the low price cure. It's been doing it since it first collapsed in 2015, 14, 15. The difference is now hedge funds are way on top of this. Hedge funds got way too long. This is just Brent managed money hedge funds basically divided by the open interest. They got way too long when we put in this peak and they completely sold out. So you can't expect crude to really go much lower when they're sold out until they get back in and have some push. But they're basically out of their longs. So that's why crude oil is somewhat buoyed, but copper looks like it's just starting to roll over. Hedge funds did the opposite. Hedge funds got way too expensive. Copper is going over. But that's what's happening now. The thing that's happening in commodities, we got to the high price cure. We're going down. We need to get a low price cure. Some commodities have done that. But now we've become to a market of individual commodities as we head to the lower plateau. And the question is of what stops it. The bottom line is the stock market has to keep going up, or things like copper and crude oil will go, they're going to propensity to go down, but they're going to go down a lot harder when beta goes down.
Interesting.
Gareth, what do you make of the petrodollar situation? I'm just curious.
Yeah, I mean, I think Mike's kind of dead on this one, and I do think that it does potentially change the landscape for what's going to happen. But pivoting away, I just want to, and I want to make sure we get to crypto because I know a lot of people are here for crypto. But before we do that, one of the things that jumped out to me recently, I was hearing from a few contacts in my financial circle that there's issues going on with some of the big banks and some of the regional banks. And I'd love to hear if any of you guys, Mike, maybe you're hearing something over there at Bloomberg. But first of all, look at this chart of Citigroup and look at the breakdown. So this thing was grinding higher and it's now broken down. JP Morgan's broken down, but I'm hearing that where some of these big banks are unloading some of their bad debt, essentially, because you have mortgage-backed securities that were put together when rates were so low. Now you have commercial real estate, which obviously, you have vacancies of 50% in some of these strip malls. Is there anything going on here that you guys have heard that could be kind of an outlier, that could be a black swan, let's say?
I haven't seen anything with the major banks. Regional banks, I think we know, are still under pressure. Right, Mike?
Yeah, the KRE is not a good chart pattern. Like, I don't know how technical some of you guys are, but this is, to me, a classic bearish pattern. And this was the low back in March of 2023, and we're not that far away from it. So,
yeah, I'm worried about, to me, all these things are all about, if the tide stays high and strong, everything's okay. You're going to see cracks in the armor like that. I mean, I've seen it. I mean, the cracks I see everywhere. We start with the inverted curve on a global basis. You look at leading indicators, they're still negative. All my indicators for commodities are declining demand for diesel. Diesel's the grease of the engine. Declining demand for unleaded gas. Declining demand for container boards. All recessionary. It's all predicated on, and that's happening with the beta staying strong and high. To me, when the tide starts going out a little bit, we haven't had a 10% correction in the S&P 500 since that bottom last October. When we get that first correction, then we're going to see who's wearing clothes, and that's where you're going to find out. And it's just a matter of time. But it's one thing I wanted to show you, and I've been showing for quite a while. It's what's been bothering me a lot about cryptos and Bitcoin is we have S&P 500 E-minis at all-time highs, and you look at Bitcoin, it's been doing, Scott's been pointing this out. You picked this out in March. It's been trading downward. It's been showing divergent weakness. The fastest horse in the race is still having a hangover. And I like to point out one key thing I like to watch, and I'll point out, I'll end with this, is you look at S&P, Bitcoin gold cross. I've been watching this for well over a decade. It's still showing divergent weakness despite, and then here's a stock market, S&P 500, just divided by its 100-week moving average. And the lesson is when you get that S&P 500 above its 20% above its 100-week moving average, risk assets usually have a problem. This is Bitcoin gold collapsing when it was back in 2018, and then it hung out for a little while during the biggest money pump in the world. And this is what I'm worried about. The S&P 500 is hovering at 23% above the 100-week moving average, and Bitcoin gold is starting to trickle down. To me, this is just a matter of normal reversion, and Bitcoin should lead the way.
Scott, speaking of Bitcoin and crypto, what are some of the biggest stories that you've been hearing over the last week in Bitcoin or cryptocurrency? And like, can you give us an update on what the flows are to the ETFs? Are we still seeing inflows?
We had a record of 19 straight days of inflows into the Bitcoin spot ETFs that actually was broken. I think Tuesday there was a day of outflows. We've gone back to inflows again. So there's effectively 1 day of outflows, very sustained inflows. The talk of the town in the crypto space right now is the basis trade, cash and carry, whatever you want to call it. People buying spot and shorting the futures that are in contango. That's been a huge trade that we obviously saw last cycle as well. A lot of people pointing to that for the reason that maybe price has been suppressed even with all of these inflows. I caution people at believing that should be a net neutral sort of thing that shouldn't really affect the market in either direction. I think miners are selling quite a bit, which Noel Atchison pointed out this morning on my show. After the halving, you have miners that are under stress. They need prices to be higher to be profitable. They sell Bitcoin to remain solvent until that hopeful next run up goes. But right now, I think we're in the halving hangover. I know that Mike points out the fact that it's sort of leaving, but I drew a chart that looked like this, a couple months ago, and I still think this is what we're doing through, October or November. Just really, really nothing to talk about, but people are going to get chopped up and destroyed trading simply in a range here. I think it's just doing nothing. I think it's just
one of
doing
my
nothing.
biggest, right? So I think that's one of my biggest questions, and like you kind of answered it, is that if you have 19 days of straight inflows into these ETFs, yet Bitcoin is net flat for those 19 days, that just seems like it makes me wonder, like, all right, well, who's unloading here? What's going on?
We have multi-billion-dollar trading volume in a day, so 100 million in a day of inflows is a big headline because it's in the right direction. But it's not that meaningful when it comes to actual proportion of dollars being traded in the market or Bitcoin being traded. But I think it's miners, and I think that there's plenty of people who are really happy to take profit at Bitcoin in the 60,000s who have been holding for a very long time, right? So I just think, and I think that whether it's animal spirits or just a belief because of previous cycles, we are talking about humans. And I think there's an expectation based on previous 4-year cycles that for 6 months after the halving, things will be really boring. So some people are probably looking to take profit, buy the 20% dip that comes somewhere in there and then ride it through, the 2025 to Valhalla. I'm not saying that will happen, but that's the expectation. 2017, 2021, 2025.
What you described about Bitcoin is the key thing I've been worried about for a while. Now, you nailed it on the way up, but I would call it divergent weakness. Yes, the flows are great, but every time it's the test versus beta. When beta keeps making new highs and this fastest horse in the race keeps kind of, despite the inflows, is not doing it, I'm worried about for all risk assets when beta does finally have a correction. And I showed you 20% above 100-week moving average is never a time you want to be overweight beta unless there's a significant reason. And there's only been one since 2000, and that was the biggest money pump in history that we got from 20 to 22. It's over. So I look at it as, okay, it can stay here as long as, markets can remain irrational, but these are still levels that big picture, obviously still very bullish Bitcoin, but shorter term, I'm worried about anything that's a risk asset. And still, what you have to point out lately, we're making new highs, and what's been doing quick catching up and doing well is TLT, is treasuries dropping. Again, people say, it's about the deficit. I'm like, have you looked at the rest of the world's bond yields? They're collapsing.
So TLT volume, by the way, there's been a lot. TLT is getting, I think, more popular again. I was just looking actually when I was looking at volume, but my I had a Freudian slip. I just wanted to point out, Mike, what's happening with miners right now. Bitcoin may not be moving, but Bitcoin miners are going absolutely insane, right? This is Iris Energy. It's one that I've been heavily in, bought between $3 and $5. 1368. It almost hit $15, or maybe did today. But you're talking about a month ago today, it was $4.69. Jeez. So some of these, I don't know if they're catching up. I don't really, or if people are fundamentally understanding what's going on here. But the beta of Bitcoin, which is the Bitcoin adjacent stocks like miners, are flying.
Interesting. So in that respect, just looking at Bitcoin, do you guys are seeing, like Mike, you're or Scott, you're seeing a lot more sideways chop, and then Mike, it sounds like to me you're seeing that if we get that reversion trade in the stock market where we actually see a pullback, then you'd expect Bitcoin to fall decently as well. Are we talking about 10%, 20%, 30%?
It's not an if, it's a when. It's just a question how silly things get first. But what Scott pointed out in that chart really hits home. In an environment with beta flat, that makes sense. Or if an environment would I'll show you on TLT there, but in an environment where you're seeing inflows and betas making record highs, that's not a good sign. Yes, it might be catch up, but we're past the two biggest events we can have ever that coincided at the same time, and that was a halving and ETFs launch. So what I want to show you is what I see happening is I'm still bullish gold, but if you take that GLD, the number one gold ETF, divided by TLT, the number one bond ETF, this white little chart shows a pretty significant peak from good levels. The last time we had something similar was 2011. And what I also point out here is when you look at U.S. Treasury yields, if you subtract them divided by the rest of the world's top 5 countries, we're about 100 basis points above the 10-year note average. That includes India. The last time we were here, we were 150 basis points below. That's the difference. And it looks like TLT, gold, GLD versus TLT is peaking. Now, I'm not bearish gold. I still think gold could drop to 2,200. Still think it's going to 3,000. But to me, the next big trade is when things start inverting a little bit and people sense the deflation. That's always happens historically. Then TLT might be the one to, it's the most beaten up asset. It reminds me of GBTC at the end of 2022. Remember how horrible it was in ETH? And then it turned out to be the best trade of the year.
So
really quick, Gareth. I think interestingly, it's always fun to take a look. It's sort of a glass half full versus a glass half empty perspective at the same things. Mike sees Bitcoin as divergent weakness leading to the downside. I personally see more than those two catalysts that you mentioned, right? I see more than the halving and more than the ETF. We have an Ethereum ETF approval that will start trading. That's not as big as a Bitcoin spot ETF, but a real catalyst. And we have the political winds changing so strongly in the United States for crypto. I think that could be, maybe not in this exact moment, more fundamentally important than any of these other catalysts that we've had. So I guess you can say, listen, why is it trading sideways when there's nothing but tailwinds? That's a negative, right? So it should be flying. Or you could say, man, this thing's going to fly when that catches up, right? And so I just kind of take the latter.
So we have just a couple minutes left, and I would just wanted to ask you guys about something that has been going on recently, and it's these mega trillion-dollar companies going up in, really like insanity, right? So just wanted to bring up Apple. So Apple has this conference, this WWDC. They're like, oh, we're going to incorporate ChatGPT, which to me, I at the time I was like, okay, it's a sell the news event. It's like, it's not like they're inventing something new or anything, but then somehow the next day it starts this epic run where it basically adds like almost $500 billion in market cap from the lows on that day to the highs yesterday. Like, what on earth is going on? Where's all this money coming from? Like, that's the bigger question. I mean, that's like $400 billion right there. Then you throw in NVIDIA, then you throw in, what the heck?
Definitely a wealth effect, and it's classic. I think it's the silliness you get at the top, but as source says, when I see a bubble, I buy into it. Never know how high it goes. Lessons I've learned trading options and puts is you don't want me getting short because it'll go higher. It's just the classic example. Let's look at NVIDIA. Its total market cap is $3 trillion, about that, compared to Bitcoin. It's like, what, 1.2, 1.3 trillion? It's, to me, that's the point is, and I talked to a prominent money manager this morning, and he pointed out we're at that stage now. You got to be in it. If you're not in it, you're falling behind, you're fired. I remember these before. Remember in 1999, I remember in 2007. We're at that stage. The difference now is inflation's really high. The rising market's lifting up inflation. The market's priced for the ease, and it's probably not going to get this ease until it goes down. And the rest of the world has started. That's why it's all predicated on that stock market going up. But one thing I want to point out is when you're a money manager and you lose money on Apple or NVIDIA or some of the top 7, it's okay. I mean, everybody else is in it. You're great. But if you lose money in Bitcoin, that's not okay.
Interesting. All right. So basically, just to summarize, these type of signals are, Mike, and you've been on the street for a long, long time. When it's this last-ditch run to chase with no fundamental backing, that's usually the sign we're getting close to some sort of bigger top.
Oh yeah, I don't know what the inflection point is going to be. I think we're going to be similar to what I predicted. I was early in 2008. but nailed that one. And 2000, and just way early, is this one's going to be the biggest one of our lifetimes. And I point, here's one simple reason why, because the market valuation, the stock market is the greatest in our lifetimes. Now we had one little spike here on the biggest liquidity pump ever, but this is just where we are now. It's just, there's certain times you're not supposed to be overweight risk assets. It could last a while, but I look for signals, and that's where I see the inverted curve or watch the rest of the world. I look at all my commodity demand pull stuff all heading lower. Sure, I've been early, and sometimes you can say wrong, but it'll happen. And I'm just looking for those points. At some point, it might happen really fast, and that is we just need, like this. We only have one little minor 5% correction in the stock market. We got to at least get to a 10% test. I like to call it test, and see who's wearing clothes. So the bottom line is, if and or we correct 10%, you should expect Bitcoin to drop by a third. Just look at the example. When Bitcoin dropped 5% just a little while ago, Bitcoin dropped 20%. When the S&P, I'm sorry, when beta dropped 5%. When beta dropped 25% in 2022, Bitcoin dropped 80%. Maybe it's different this time. I like to say, prove it, show it to me. And I like now I'm showing the opposite. I'm showing that divergent weak, or seeing the divergent weakness.
Awesome, buddy. Wonderful. All right, let's end it right there. Great episode, guys. Great insights from both of you. Thank you so much. Socials are at the bottom, guys. Please follow these gentlemen. They are amazing, and we will be back next Thursday at 3 p.m. So we look forward to that. You guys, thank you so much for coming and participating. We'll see you then. Take care.
Thanks, guys.